Hello traders, how are you doing? This is Dan and this is Dan Tech channel. In this video we're just going to be talking about fundamental analysis, and as I always say that if you don't check on the fundamental analysis, does not matter how good you are on the technical analysis, then you're just going to lose most of the trend. So this shows us that the fundamental analysis is the very good aspect that you have to be knowing. So in this video actually, and more of this, I'm going to be explaining everything that you just need about to know about the fundamental analysis, especially the main and the major component that actually affect the market. So when we are talking about the fundamental analysis, when you are checking on the fundamental analysis, you have to know that actually 80% of the institutional firms and the hedge firm actually they trend that is fundamental analysis. So this is very important video to you as a trader. The other thing that you just have to know is that when we are trading on the fundamental analysis, actually you have to be checking on a specific currency. Let's say for example you are trading that is Euro USD, you have to be checking each component at a time. For example, you have to be checking what is happening maybe on the USA, that is USD, and you have to be checking what is happening to the euro, where that is the Europe, and then you can just match that up to come up with the good fundamental analysis. So in this video, what I'm just going to do, I'm going to start with the fundamental analysis for the USA, that is United States, that is US dollar, and the major component that actually comes and drives this US dollars. And this video is just going to be very interesting. So if this is your first time actually to be over here, welcome so much. We deal with forex trading and analysis and all, and talk about if you're a beginner, I mean those classes where you can just go through to learn more about the forex trading. You can subscribe to the channel, turn on notification bell, you'll be notified anytime I just upload a new video, and make sure that you like this video. It will be recommended to more and more people. So without wasting any time, let's start this video right after the intro of this video. Now traders, let's look at the fundamental analysis for US dollar, and we're just going to be looking at this, what is happening over there, the factors that actually affect the US dollar in the USA. And I just said earlier is that the institutions and the hedge fund actually they trend 80% of this fundamental analysis side, and the technical analysis they just used for the confirmation. That is what you just have to know there. So that you can see there's difference between us and actually those big firms over there, and there are actually different factors that you have to be considering over here, and there are things that you have to be looking right over here, like liquidity of the market, for example. So liquidity, this is where the market actually, you see the market producing so many buying opportunities, and actually there are a lot of movement, and that is what you have to be just looking at. So going direct to the fundamental analysis for the USD, actually there are things that you can just be looking over here, like the major export and import of the USD that you can just be looking at. You can just be looking exports and imports, yeah, that is in the United States. You can use that is to be checking who are trading partners, yeah. So and a lot of things that we're just going to be looking over here: amount of reserve held and currency regime, credit ratings, frequency of intervention, and government. Okay, so we just be looking at that. Let's just go direct to the fundamental analysis of USD, which is very important over here. And the other thing that you just have to be looking at, the reason I said you have to be looking individual platform, is that you can just go to the economic calendar right over here, and as you can see Forex Factory over here on the calendar, you can just be using and to check every currency at its own thing. So you can see like on Tuesday, January 3, this is 2023, you can see like there is an Germany employment that is in euro. You can just be checking like USD constructions, all this. So we'll be looking at the major things that you can just be checking over here, because you cannot look all of them, because they are major of them that you have to be checking that affect the market so big right over here. It is just going to be very easy. So why USD? Why have I started with USD? Is because 80% of international transactions actually 80% of international transactions actually are carried with USD. So it is actually obvious that almost everyone knows about the USD. And you know, in the forex market also, the commodities actually they are written in terms of USD. For example, you can just go maybe to the oil, all of them they are just priced in USD. And what you have to know is those commodities actually they are inversely proportional to the USD. So if the price of the USD goes high, the price of the commodities actually goes down. So that is the thing that you just have to know there, that US dollar is actually the safe haven. You know, this is the safe haven. Why? Yeah, this is the safe haven where people actually come to buy when things are just going to be very bad. Why? Because many currencies are pegged to USD. USD is just defined as a stable coin and used mostly because USD is a reserve currency. This means when the times are bad, capital will just flow in safe haven market for the safety, and that is for the US dollar. So that is what you just have to know, be knowing over there. What we have to be knowing about the US, actually USD, is that apart from being the safe haven, is that the US dollar actually will just USD will depreciate when its economy depreciate. You know, does not matter how this country is gone, how they have reserve, but when actually their economy is banned, you expect the currency actually to just go down. What you have to know actually is the that what you just have to know is that more of the services are oriented in US, 70% to the economic contributions. Okay, and you have to know that the US affect the other partner currencies they contribute. Okay, they affect the other partners. For example, I'll just be driving it over here. For example, we have export, where the US actually export mostly, and we have import over here. We know actually they import mostly on Mexico, on Canada, and also they import from China. Okay, on the export side, they export to Canada, Mexico, almost the same, so, and China. So these countries, as well, you can see over there, they have a lot of contribution to the US dollar. And all you just have to know is the US actually contribute 25% to the global growth. So that's very incredible. That's a quarter% of the growth of the economy of them globally. Okay, so I'm going direct to the major economic indicators. This is where I was ending. That was all of that was just an intro. So let's just concentrate right over here, which is major. I even write this in rand form so that you major economic indicators. Major economic indicators. Major economic indicators. So this is the important part. This is the reason you have to be knowing about this video. Now, there are different factors that actually affect the US dollar, and these are the major ones. The other are just minor. Okay, the number one of these actually they are not written as the number 1, 2, 3. All of them are the major ones that can just affect the market, and actually they just determine with what I'm going to share at the end. So number one of it, we just call it employment. Okay, we have like employment. So we have employment. So for example, when you just go to the economic calendar and you see something about employment, the most of the time you just see unemployment. Okay, so when you know that most people get unemployed, for example, when we have most people unemployed, when we have so many people who are unemployed, we expect the currency to do what? To follow. Okay, so when unemployment rises, when unemployment goes high, this is unemployment. When it goes high, what we expect about the currency is the value of the currency to weaken. Okay, you know, like in the country, when many people are not employed, the poverty just is there and they don't have money to spend, which drives the currency actually to weaken and all that. So you can say unemployment is inversely proportional to the strength of the currency. Okay, when there's high unemployment, the currency actually goes down. When there is high employment, you expect things to go good for the currency. So this is unemployment, not employment. Unemployment is inversely proportional. The reason I'm talking about in unemployment is because that is what is shown mostly on the Forex calendar. Forex factory calendar, most of them they show unemployment rate. So number two, we are just going to be talking over here is that we are just going to be talking about GDP. GDP over here means gross domestic product. Okay, so this is very easy to memorize because they are very easy. These are the main ones that affect the US dollar. You know, the gross domestic product, this is like the country produce, how the country actually are producing their goods and all that. So actually, you know that when the people are producing more, they tend actually to get maybe more money on the export, and the currency actually, you expect the currency to go higher. It's like when people have money and they are exporting maybe their goods because the domestic gross product is going high. Okay, so here we can say GDP is directly proportional to the strength of the currency. Okay, is directly proportional to the strength of the currency. The other thing that we're just going to be talking about over here is the CPI. So people actually know this one as inflation. So inflation, actually this is something that is affect the market and affect the currency in a very high force. And actually when it comes to CPI, which is consumer price index, as I think the other name is inflation, as people know. So how do inflation is measured? You can just go to the cost of maybe goods that is now, and then you just divide by the cost previous, and then you multiply it times 100. Okay, so the reason actually people look at CPI is because it has an effect of increasing rate or reducing rate in future. Okay, I'll be looking at that. For example, let's say the price of the Brent now is at 100 Kenya shillings, but the previous was 50 times 100. So you can see the price of Brent, this is 2, which is 200%. So you can see over here the inflation has gone times 2. It's like the increase in price. So what people will see over here, so when we see ICPI, we expect the government to come over here and increase the interest rate so that it can curb this inflation actually to just maybe go down, because this is very high inflation rate. And the opposite actually is true. When the price of Brent is now 50 and it was going at previous at 100 times 100%, which is here we have 50%. So you can see it is very low. So what government will just do over here is to lower the interest rate so that it can encourage its citizens to spend more. Okay, so with that talk about that, let's talk about the number what? Let's talk about number 4, which is the interest rate. So this is interest rate. I'll be talking about the 5 of them. So interest rate. So as you have seen, when for example you see hiking of interest rate comes, when we come to the hiking of the interest rate, what the government does is that for example, let's see, we have experienced high inflation. So when interest rate comes, for example, the government hikes by 50 bps, that is points. Or let me talk about the CPI. Okay, so assume now the CPI was 200, which means the inflation was very high. So here the government will just increase the interest rate. So you know, when there is inflation, very high inflation, it tends to weaken the currency. Since people are spending more money, that is to buy the goods, you know, and that is actually what we just call the inflation, you know, spending more amount of money buying the same product. Okay, so what the government will just do over here is to come and increase the interest rate so that it can strengthen the currency. They can just maybe minimize that the spending of the people, and people can now save, and it will just make the currencies to be the strong. So we can see the interest rate is directly proportional to the strength of the currency. Okay, so interest rate, actually these are the major ones that affect the market. The interest rate, CPI, if you see that, unemployment, and GDP. So those are actually the factors that affect the market. Number 5, let's talk about the last one, which is the consumer confidence. Consumer confidence over here involve consumer confidence. You know, consumer confidence is like the sentiments, how people feel about buying the product and all that. So as you just know, when the confidence is very high and all that, it tends to strengthen the currency. When people are positive, okay, when people are positive, that means there's no fear. So you can say consumer confidence is directly proportional to the strength of the currency. When there is high confidence, you expect the strength of the currency that is to go higher. So that is what we have to be looking on the major indicators, on the economic indicators on the US dollar. When you just go maybe over here to the Forex calendar, what do you look? You can just be looking on those things. So you'll be coming to other currencies, because we have started just with the US dollar. So for example, here on this day, you can see there are a lot of things that we just be expecting right over here. Okay, so like for example, on the US dollar, we don't expect big news to happen on that date. You can even come to the next day over here and to see until when are you expecting maybe to see. As you can see over here, that is on 5th we expect unemployment claims over here. That's why I was talking about unemployment and not employment, because you see over here there's also predictions. So the previous was 225 and this time we expect 230. That means there over here, that means, for example, on the predictions over here, previous was 230,000 unemployment, 225. Previous was 225k unemployment, but this time maybe we expect 230k or more. But now, what does this indicate to the currency is that people are, it is just going to weaken the currency, that day, at that hour when that news is just released, you expect the currency to become weak, because so many people are just going to be announced as unemployed. So that is what you just check on the Forex factory, on the Forex calendar, before even you just trade. If you like this video, make sure that you subscribe, turn on notification bell. You'll be notified anytime I just upload a new video. If you have any question, leave it in the comment section. I'll reply or your comment. If you are finding the broker that you can just use to with actually even zero spread, fast withdrawals and fast deposit, just look over here. FXPesa is just there, the link is there. Just join using my link. It will just be very easy for you to register. I will see you next time. Bye bye.